Hi, this is Robert Reiss on the CEO Forum, and we're here today with Tim Mayopoulos. How are you, Tim?
I'm great. Thanks for having me.
And Tim is the CEO of Fannie Mae, and everyone has heard of Fannie Mae, but not everyone's sure of what it does. Later in the show, we're going to talk about how the housing market is changing and what insights are going into there and how technology is transforming the business. But for now, let's start off. It's 1938. Why is there a need for Fannie Mae?
So Fannie Mae was created in the wake of the Great Depression because the way people had financed their homes in the past was no longer working through the Depression. They would get 5-year bullet loans and they would make the payments on those loans, but if they couldn't get a new bank to give them a new loan at the end of the 5 years or get the old bank to renew the loan, they lost their homes. So a lot of people made their payments through the Depression, but they got foreclosed on. So FDR came up with this great idea that said, look, we need to have an institution that will ensure that there's liquidity in the mortgage market at all times and in all markets across the country. And he also came up with this idea that we should have long-term fixed-rate mortgages, a 30-year fixed-rate mortgage, which most Americans just take for granted, but we're actually one of only 2 countries in the world that have 30-year fixed-rate mortgages.
I was not aware. What's the other one?
The other one, I think, is Belgium, but the key to that is that it allows the existence of Fannie Mae ensures that people will be able to have access to credit all the time, and that's been a critical cornerstone of the U.S. housing market ever since.
And in 1981, things changed for you.
Well, in 1981, the company was privatized. Originally, Fannie Mae was a government agency. We're not a government agency
You're
anymore.
a GSE.
We have a congressionally granted charter that gives us a set of public purposes that we're supposed to fulfill, which essentially is to provide liquidity to the mortgage markets all over the country at all times. And then at the same time, we are to run the company in a private sector sort of way with commercial orientation and world-class risk management and other practices.
And you actually have a stock price now.
We have a stock price, and unfortunately, as a result of the financial crisis, the government had to step in and put money into Fannie Mae, and it did that not because it really wanted to bail out the shareholders of the company, and frankly, many of them really got wiped out in terms of their financial interests, but really needed to support the housing finance system. So we continue to have shareholders, but we really manage the company for the benefit of taxpayers.
And a GSE, government-sponsored enterprise, you're beholden mostly to the government.
We are beholden. The government is our key stakeholder at this point. The Treasury Department has warrants for 79.9% of all the equity in the company. We send all of our profits over a little bit of retained capital to the Treasury in the form of dividends. So every quarter.
And those have been pretty significant. They've been I think over $200 billion.
It's been very significant. So the taxpayers put about $116 billion into Fannie Mae through the crisis. In terms of what we've paid back, we've paid dividends to the Treasury of that 116 plus another $50 billion on top of that. So, this is a situation where, frankly, when I joined the company almost 9 years ago, we thought it might take 20 or 30 years to be able to give that kind of return back to the taxpayers, and we've been very pleased that we've been able to put the taxpayers back in the black. We're all taxpayers, and we should be pleased with that result.
This is Robert Reiss on the CEO Forum, where we speak with the CEOs who have transformed the fabric of America. We're here today with Tim Mayopoulos, who is the CEO of Fannie Mae. And so let's just finish up on 2008, 2009, before you came. What lessons were learned from that debacle?
So some very fundamental ones, obviously. I've been in the finance business for a long time. I grew up in this business as a lawyer, but I've worked in 3 investment banks. I've worked in a big commercial and consumer bank, and now at Fannie Mae. So I have a pretty good perspective on all the things that were going on leading up to the crisis. And I think fundamentally what happened was just a gross deterioration of credit standards in the mortgage markets. And that was a function of a lot of things. But basically, what happened to Fannie Mae was that Fannie Mae is different than most of the other actors in the market. It actually stands behind the mortgages that it buys. Okay, so we actually.
What do you mean stands behind?
So we literally guarantee all the principal and interest payments on all the mortgages that we acquire and put into mortgage-backed securities. So when an investor, when a buyer of one of our mortgage-backed securities buys that security, they're not taking any credit risk. They're taking what's called prepayment speed risk, and they're taking interest rate risk. But they're not taking the credit risk. We're taking all the credit risk. So many of the other participants in the mortgage market in the years leading up to the crisis, they were essentially just conduits. They were taking the credit risk and they were packaging it up and selling it off to investors, but not doing, frankly, a very good job of determining what that credit risk really was. And unfortunately, many of the investors in those other private, what's called private label securities, they weren't really doing a very good job of inspecting that either. They're basically just relying on credit rating agencies and others to just tell them that, yeah, these are going to be money good. So the credit standards really deteriorated, and we saw the advent of liar loans. We saw the proliferation of many different sorts of risks that got layered on top of one another. We ended up with no documentation loans. Those things were all really bad practices. I wasn't at Fannie Mae in the years leading up to all that, but my impression is that the company tried to resist getting into that part of the market, but that became an overwhelming part of the market. And I think what ended up happening was that Fannie Mae and a sibling company, Freddie Mac, ended up becoming slow followers into that market. Unfortunately, given that they actually hold all the credit risk, when the market turned, they got crushed. And so you ask, what's the lesson learned? Lesson learned is we need to have really solid credit standards. We need to hold firm to those credit standards. We need to inspect the loans that come to us before we actually buy them. And we've put technology in place to make that happen. The system is much safer now than it was before.
Day one, you come in, you weren't CEO because then you became Chief Administrative Officer, but 2009, 2010, day one as CEO, what was the first thing you thought of when you said, well, we've gone through these challenges, I know the lessons we've learned, what do I do operationally and strategically as a CEO?
So the key was to continue the reforms that were partially underway at the company, but really pivot towards the future. So what do I mean? So we made some fundamental changes to our business model. We ended up, as I say, we hold all this credit risk. We have a $3 trillion balance sheet. So we have $3 trillion
$3 trillion.
$3 trillion worth of mortgage assets. Historically, Fannie Mae would have held all that credit risk for the duration of those assets. Mm-hmm. So if you had a mortgage that lasted for 15 years, we were holding that credit risk for those 15 years. We concluded that with our regulator, one of the things that we ought to be doing is trying to transfer as much of that credit risk as possible into private capital. So through capital markets transactions and reinsurance transactions, we now transfer a very big part of that risk to private capital, thereby insulating the taxpayers from that potential risk. So that was one thing we needed to do. Another thing that we were very much focused on was reducing the risk that we had from a very big a pool of investment assets that the company historically held. The company made most of its money historically from the difference between its cost of funds, how it could borrow money, mm-hmm. what it paid for that, and the returns it could get on these investment assets. And so we had at one point up to $900 billion of those assets. We concluded that was too risky, and then we have wound that down, and so now that number is about $50 billion and going close to going down to zero. So really fundamental changes to the risk profile of the company. So operationally, my view was we needed to continue on that path and make those things happen, but also now pivot away from the past. Okay, so we spent an enormous amount of time when I first got to the company figuring out how to help people stay in their homes if that was at all remotely possible. But as the crisis, as we worked our way through the crisis, we want to start focusing on the future. What should the future look like? Not just fix the problems of the past, but how do we create a housing finance system that will better serve the company going forward?
This is Robert Reiss on the CEO Forum. We're speaking right now with Tim Mayopoulos, and he is the CEO of Fannie Mae. When we come back, we're going to hear more about what's happening in the future, but we're also going to hear he actually received a 92 on Glassdoor, and I know CEOs, you love to hear about that. How do you accomplish something like that? Back in a few. Hi, this is Robert Reiss on the CEO Forum, and we're here today with Tim Mayopoulos, who is the CEO of Fannie Mae. First, one quick thing. Only give me 2 sentences.
Okay.
What's the difference between Fannie Mae and Freddie Mac?
So essentially, we're in the same business today. The companies have two different histories. Fannie Mae was created in the 1930s. Freddie was created much later to really serve the savings and loan market. But today, the companies do basically the same thing.
Okay, so now let's go into you as a CEO. Now, what did you learn? You know, you were general counsel, Bank of America, you were Polk Davis, a lawyer. You had all these different backgrounds. What did you learn personally in terms of leadership that was the most important element that you brought in as CEO?
So one of the things that I've become acutely conscious of, just watching other CEOs in various places I've worked and observing the world, is that the key to success is really around teamwork. That it's very difficult to lead any large, complex institution all by yourself and be successful at that. So I'm a huge believer in teamwork, and I'm very focused on bringing great people around me. I don't want to be the smartest guy in the room all the time. If you are, you have to do all the thinking. I want to have really talented people around me who are challenging me, who are challenging each other, and really create the cohesiveness to really drive as a team forward to achieve great things. So that's been my philosophy as a CEO.
And when you get up in the morning, the first metric you look at, the first thing on your mind of how you're going to be a great CEO, what is it?
So I wake up every morning and essentially tick through all the people on my leadership team and say, which one or two need to be doing better, and what can I do to help them perform better? It's not about me personally, it's about us collectively as a team. How do we get the most out of each other? And I think my job as the CEO is not to micromanage all those people, it's not to do their jobs, it's to do the things that a CEO is supposed to do. Set strategic direction, create an appropriate tone within the company, and eliminate obstacles to other people's success.
And you've got to be proud of getting a 92 in Glassdoor.
I'm proud of it, although frankly, the Glassdoor rating is about how people rate the CEO. I'd be much happier if Glassdoor was rating the management team.
So, what is the number one thing that's most important to you that you want to accomplish with Fannie Mae?
So, in many ways, we've accomplished an enormous amount. We have delivered a lot of return back to the taxpayers. We have...
and by the way, that $116 billion is all taken care of, and now it's going forward.
Well, it's an odd thing, but the legal, and as a lawyer I appreciate this, the legal construct is that since all the money's been paid back in the form of dividends, and it hasn't actually extinguished the debt legally of the original $116 billion. But that's... so
you got to pay it twice.
So we got to pay it twice, essentially. But what I think about what we want to get done, we obviously want to do good things by the taxpayers. We want to reduce the risk to the taxpayers going forward, which we've done through the reforms I was describing earlier. But most fundamentally now, I want us to be focused on innovation and driving the future of housing finance. You know, there have been points in Fannie Mae's history during my tenure as CEO where I've actually had to stand up in front of all of the employees of the company and say, you know what, policymakers are debating what to do with us. There was for a long time talk about winding us down. And I would say, look, we all have to accept the idea that maybe Fannie Mae will actually cease to exist at some point, and we shouldn't worry about that so much. We're not here to preserve Fannie Mae per se. We're here to actually build a great housing finance system that can serve the country for the next 10, 20, 30 years. And that's what we've been focused on.
So let's talk about the future. We're in a world that's digital with AI. Everything is changing in financial markets and housing markets. What is the future?
The future of mortgage finance is to become a truly digital experience. Anybody in the United States who has a mortgage has been through probably a very
Is that tying into like blockchain?
Well, blockchain could potentially serve some functions, but fundamentally we just need to think about the mortgage process like any other consumer experience. So consumers now are defining their experiences by reference to Amazon or going to the Apple Store or being able to do a search on Google. They want access to financial services in the same way. So obviously getting a mortgage is a little bit more complicated. It's a big life decision, but we should make this as easy as possible. There's no reason why people need to scoop up piles of paper and go to a fax machine if they can find one and send it to their mortgage banker. We should be able, through digital processes, allow consumers to give us access to their income, their assets, and their financial transactions so that we can actually see that they are good credits. And that's what we are underway with. We've actually created the technology to allow that to happen. so that we can actually inspect the creditworthiness of borrowers virtually in seconds once we have access to that information. We're doing the same thing on the collateral side. What is the house worth that you wanna buy? We have this enormous database of collateral values, of house values all across the country, and we give our lenders our view of the quality of the appraisal that gets done almost instantaneously once they send the appraisal to us. So they send it to us digitally, we give them a response, and we tell them, here are the questions that we have about this appraisal. If we have questions, and if we don't, we say, this appraisal looks great to us, we're good to go.
And on that experience, you're more B2B or B2B to C. So it sounds like you're impacting the business to consumer market. How do you really accomplish that? You're starting to talk it through about how you give them real-time data.
Right. So we are a B2B company. We're not a B2C company. By our charter, we're not permitted to make loans directly to consumers. So our job is to help our customers, the lenders who make loans to consumers, as easy as possible for them to create a great consumer experience for their customers. So that's what we're all about. But since virtually everything in housing finance flows through us, if we don't enable that, that won't be possible. So it's really important as the backbone of the housing finance system that we continue to do that.
Okay, let's talk a little bit more about, we're moving into a world of AI. Will this have any impact on housing? What are the key elements that are going to drive housing market in a certain direction?
So I certainly think that things like machine learning or artificial intelligence is going to make it faster, less expensive, and safer to run our housing finance system. It will allow us to avoid unreasonable risk, it will allow us to avoid fraud, it will allow us to do things faster and less expensively. And hopefully all of those savings get passed on to consumers. That's fundamentally one of our goals, and the reason that's so important to us is that at Fannie Mae we really care about affordable housing. We really care that people have access to credit, people who are credit-worthy borrowers who can sustainably own a home. We don't think there's any point in putting people into homes they can't actually sustainably afford, but we actually believe in affordable housing. So if we can reduce all these points of friction and pain in the system, we can allow more people to actually get access to home ownership if that's what they want to do.
So we've about a minute and a half left. Let's talk about CEOs. What is the message to CEOs of how they should be involved in improving our economy?
So look, I think fundamentally we all need to be open to innovation. And I think every CEO I talk to and every CEO conference I go to, this is what CEOs are focused on and should be focused on, is there's a revolution going on out there. And some of these technologies will be fantastic, and some of them may not have all the promise that they currently appear to deliver. But we know that the world's going to change. It's going to change faster and faster. The pace of change is remarkable. And so what I'd say is we all need to be open to the prospects of change and innovation. We need to be adaptable, nimble, agile as we go ahead and move forward.
Okay, what is the website for Fannie Mae if someone wants to go there and read up more on it?
So we're at fanniemae.com. That's FANNIE MAE.com. It's not the candy company, it's the mortgage company, fanniemae.com.
There you have it. And Tim, it is a pleasure speaking with you on